I'm still, stuck in my adolescence, obviously. All right, did you guys need any blue books or anything?
Yeah, can I actually, I forgot mine, but mine's pretty full. So
Okay.
do you happen to have any extra?
Yeah, we can grab them.
Thank you.
And you brought your exam and everything?
Yeah. I just, I came straight from home, so I didn't have to bring everything.
You need one?
I have an exam, but it's just not filled out.
Yeah, no, that's fine. I just want to make sure if you
I
have.
do have questions.
Yeah, that's fine.
Perfect. The extra credits due next week.
Yeah, it's due with the deliverable.
With the deliverable?
I'm pretty sure. Yeah.
What's the deliverable? Is that like with everything?
Yeah, it's.
Oh.
Oh no, this isn't
Monday?
it.
Or the following week?
No, I think it's this week. I think it's due Wednesday, and it has to have all this in it.
Homework. Is that Monday? Wednesday.
Wednesday, I'm pretty sure. Yeah. Yeah.
Okay,
Yeah,
cool.
yeah, it's overwhelming, but.
That's a lot.
In-class quiz.
Just hit it so quick.
Right? Yeah.
Okay, here's some extras.
Sweet.
Did you want to do specific questions or do you want me to go through the whole thing?
That would be great just to go through the whole thing.
Okay.
There's some like not as good, but it'd be great just to.
Well, I can go through it. It'll probably take like an hour and 20 to do the whole thing.
Sounds good.
All right.
For the deliverable due Wednesday, how do you want it? Do you want it like in a binder or folder?
I'd like it in a, using one of these ball clips
Yeah.
things.
Okay.
And then you'll have a cover page, and then the memo,
Okay. Yeah.
and then the notes will go right there, and then I'll put the exam right on top of it.
Is it just a singular memo? The one we
Yeah,
did?
just the one, and then we'll just start burning through the
Yeah.
rest of them.
Okay, sweet.
And then you'll have the homework, and then the extra credit problem set, if you do that. Then the movie review,
Got it.
then the pretest, and then the resume.
Got
I think that's all I
Yes.
Okay? All right, so let's go through it. When building a forecast model, what are the first steps that need to be taken? Well, the first thing I'd like to see on the exam is the regression equation. Okay, that's like the first thing I look for. And it's the y hat, which is your independent variable, the alpha, which is the intercept, the beta 1, x1, make sure you put the hat, on top because those indicate estimates. And then beta 2, x2, beta 3, x3, and the betas, remember, are coefficients, or basically weights. And then when you run the regression, it's going to kick out the t-statistics. And you're going to be able to look at the t-statistics, and if they're plus or minus, 1.25 or higher, it means that the plus or minus, it means that the variable does a good job of predicting the dependent variable. Okay. And then, as we know, these variables can be over time, that's time series, and if they're one period of time, and they're across a panel of companies, that would be a cross-sectional regression, just a little bit. And then what are the first questions that you would ask if you were asked to, build a forecast model? First thing I would do is say yes. Can you build a forecast model for me? The answer is yes. And then the thing that the series of questions that would come out of your mouth would be, what is it that you want to forecast? In finance, it's going to be return on equity. And marketing, it's going to be, advertising revenues or revenues. In marketing, it's going to be sales. And then for the operations side, it's gonna be production, with, we'll just say return on equity. And then what I would ask too, not after what dependent variables do you wanna forecast, what variables do you think drive return on equity? So you start soliciting expertise from the individual that's asking you to do it. And then the next question would be, when do you need it? And then the next question would be, do you have a budget? And what would be the resources available to me? Because I may need to buy data, and I might need to hire some consultants, or I might need to take some people away from another area of the company to help me, build this model. And then I would go out and talk to other experts internal to the firm that have expertise and knowledge in what would drive, let's say, return on equity. And then I would probably ask other people outside the firm if it wasn't proprietary or there wasn't, intellectual property rights associated with it. And the next thing I would do is I would go find industry research, and I would find academic research that had been conducted around this subject, such as forecasting return on equity. And I would go do that. And then I would basically take the survey research that I did on variables and the academic and the industry research I did on the variables, and I would look at what variables popped up the most, not only in the interviews but also in the industry and the academic literature. And then I would collect the data, I would run the regressions, I would back test and forward test the results, and if they look like they work, then I'll make the forecast and then present the results to the senior level managers or the board of directors and make my recommendations based off of those results. Okay? And then again, determining the dependent variable is going to be really based on the area of the company that you're in and really who your client is. Okay? Either internal client or external. And then the independent variables that we just talked about that. How many variables should be in the model? No more than 5. And even with 4 or 5 variables in the model, there still may be multicollinearity, and we'll talk about how you cure for that. And then how would you test for the variable in the model significance? You're going to use the t-statistics, which are going to test the independent variables, ability to predict the dependent variable. So you have individual t-statistics in each of the variables. And then the model itself is going to be tested using the F statistic. And again, the T statistics should be, plus or minus, 1.25, but they can go as high as 2. But anything above 1.25 plus or minus is a good indication. And then for the F statistic, I would say anything around 5 to 8 is good. And when you start getting into the 13, 16, or 20 plus range, you're running into multicollinearity. And then it asks you, if you were experiencing multicollinearity in your model, and if you have 2 variables that are highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? Most students would keep the one that has the highest T statistic or correlation to the dependent variable, but the methodology, or the rule is that you would pick the variable that recurs the most in the literature and makes up the theory around that subject. Internal validity is basically getting buy-off, on your model and your model results, and actually bringing in internal stakeholders into the model development process. But internal validation, is key to be not only using the model but also presenting the results. And then external validity is using the industry and academic research to validate your model. And that's how you would achieve internal and external validity.
So internal is like the experts in a firm, and external would be like the outside sources.
Yeah, exactly.
On the one that says is how many variables should be in your model? You said no more
No,
than,
no more than 5.
no more than 5?
Yeah.
Okay.
And I like to see this equation, that's like the first test, the test is, do you even understand, you know, how these forecast models are structured? Okay? What we can do too is once we run the regression, these weights are gonna be these weights are gonna be solved, okay? And then what we can do is we can forecast the variables. We can go ahead and forecast the variables into the future, you know, for how many quarters or months or days or years or whatever it is, and it's gonna kick out the forecast for the dependent variable. It's pretty cool, it actually works. Okay, any other questions?
Yeah, I'm a little confused on testing for the variable model significance.
Yeah, that's the F statistic.
Oh, that's okay.
So when you run the regression, like in Excel or any other application, you're gonna get a regression diagnostics page.
Okay.
That has all the diagnostics, and they're gonna give you an F statistic. And that's gonna test the model's ability to predict the dependent variable.
Thank you.
Okay, any other questions? No? Okay. And then the next question basically states, what I was trying to get at in that question, that we're still trying to get at today, because actually over the last 2 weeks, the Federal Reserve has pumped over $120 billion of cash into the system. The short-term money market was failing. There was a lack of liquidity in the marketplace. So the Federal Reserve stepped in and pumped, printed and pumped about $121 billion into the system. The first time in 10 years. Okay. So maybe it's not the early stages of another financial crisis, but it does kind of bring up some questions. Okay, so this section B is on macroeconomic foundations, unorthodox monetary policy, quantitative easing, and negative interest rates. And the question is, the first question is kind of a trick question, because the size of the Federal Reserve balance sheet and the money that banks hold on reserve are pretty much the same, okay? And the size of the balance sheet between, I think I went over this before, I would say 1970 through to 2007, the average size of the balance sheet at the Fed, and the amount of reserves held by banks at the Federal Reserve. Between this time period, it was around $250 billion, and reached as high as $800 billion, for an average of $500 billion. And then the Federal Reserve, in 2008, 9, and 10, in that period, 2008 to let's say 2013, the Federal Reserve printed unprecedented amounts of liquidity and pumped it into the system to lower interest rates to basically allow the market to clear, but also stimulate the economy and get it out of a recession. And at that point, the Federal Reserve pumped as high as $5.3 trillion. So it expanded its balance sheet to that much. And then over the last, I would say, 3 to 4 years, it fell to around $4.3 trillion. And currently it's about 3.7 trillion, although it went up 121 billion, just the other day. So it's moving back in the other direction. This is unprecedented, the size of this. This has never been done before in history. Okay, just to give you kind of an idea of where we are these days. So that kind of answers the second question. And again, remember that the reserves and the balance sheet equal each other. So the size of the Federal Reserve balance sheet and reserves that banks hold on reserve at the Federal Reserve is 3.7 trillion. So that's the answer. to 2007, we gave that to you here, and then showed you, where it is today, which is it's pretty amazing. And then what has been the growth rate in the money supply since 2007? Has the Fed hit gross domestic product, employment, inflation targets? If we were to fall into a recession, would the Fed use negative interest rates? And what would be the impact on the economy, asset prices, savers, investors, and businesses? So really, to answer that question, we got to use what is called QTM, quantity theory of money. And this is also called the theory of exchange by Irving Fisher. The same guy who invented the Fisher equation. This was, I'm sure there's other models, but these are the only models this was the model that came to me first to try to explain really, since the Fed printed, such unprecedented amounts of money, the question was, why wasn't the impact on GDP and inflation greater? Okay, and that's what we were trying to figure out. So QTM is GDP, real GDP doesn't include inflation in it. So it basically strips out the inflation piece. Times the inflation rate. Is equal to or related to the velocity of money times the money supply growth rate. It's a very simple model, but it's actually extremely powerful. And the velocity of money is the number of times a currency turns over in the economy. So it's like, 6 times, 9 times, those things. Okay. And liquid money, actual currency, is also called M1, so it's the actual physical currency in the system, is M1. And then M2 is near liquid. Securities, or, that could be like money market mutual funds that can be converted to cash very, very quickly. Okay. All right, so there's the equation. So the question was, has the Fed hit its target, on velocity and inflation over the last 10 years, which is what they're trying to target. And between 2007 to 2019, which is where we are, GDP has been around 2.7%, and the rate of inflation has been around 1.5%. The target for the Fed is, for GDP is 3%, and for inflation is 2%. So over the last 10 years, the question is, has the Fed hit the target? And the answer is no. In 2018, in the first quarter of 2019, GDP was 3%, and the inflation rate was 2%. So in the short term, the answer is yes, but in the long term, the answer is no. Okay? And for the rest of 2019, 2020, the forecast for GDP is 1.2%, and I would say even inflation is actually probably around the same too. So next year, inflation, will the Fed hit the target? The answer is no. Okay. And then
Wait, you put 2018, what is it?
2018 in the first quarter, 2019.
Thank
Okay. And then unemployment right now. Currently is running at around 3.7%. And the Fed's target is 5%. Target. And actually, the Fed has exceeded its target on unemployment, or the unemployment rate. And that's if you believe the unemployment rate is true. And there's a big debate that the true unemployment rate or underemployment rate is actually double this. So the underemployment rate is probably around 8% to 10%. And the real measure of the labor market, in my view, is labor participation rates. And that's at basically 63%. And historically, it was at 73%. So if you use probably more accurate measures of the labor market, the Fed hasn't hit its target either. But they're reporting 3.7, so from the stated numbers from the Bureau of Labor Statistics, the answer is yes. But if you look at the real, unemployment rate, underemployment rate, and labor participation, the Fed hasn't hit the target in the labor market. Okay, so really overall, if you really look at the numbers, the Fed hasn't hit employment, inflation, or GDP targets. Okay, and the question is why? Do you have a question?
Oh no, I was just thinking about like what we talked about in my economic class last year. It's like the unemployment was people who are actively looking. Does that apply here?
Those are the people, and then when they stop looking or they roll
They're
off,
not considered
they're not
unemployed.
in there, so it basically causes the unemployment rate to go down artificially.
Okay.
But the labor participation rate and the underemployment rate picks up those people.
Okay, got it.
Okay. And there's a debate, obviously policymakers love to talk about this one, but the true, economists, everybody who lives in reality understands this. Okay. Okay, so the question is why? All right.
Oh, why?
Yeah, that's the question. So I kind of laid out
Everything.
the argument, and then the question is why, why hasn't GDP and inflation hit its targets? Okay, so you got to step back and you got to look at, first I'm going to isolate and control, for the velocity of money. We'll talk about that in a minute. So if I hold the velocity of money constant and I hold the inflation rate constant, then if money supply growth rate goes up, then GDP should go up. So if the Fed pumps a bunch of money into the economy, it should drive GDP up. Okay, and then the other assumption is, well, if you hold GDP constant and you pump and velocity constant, and you pump a bunch of money into the economy, if this goes up, then the inflation rate should go up. So the Fed should be able to hit its target by pumping money into the economy. Okay. Now, the money supply growth rate, which again, this is part of the answers on the exam. For example, between 2008 and I would say 2011 in there, the Fed was growing the money supply at around 30 to 40%, which is unprecedented. The Fed's never pumped that much liquidity or printed that much money before in history. And then I would say between 2013, 2017, the Fed was growing the money supply growth rate at around 10 to 8%. And recently in 2018 to 2019, the rate of money supply growth rate has fallen to around 5 to 8%. So you can see that the money supply growth rate has been decelerating significantly. And if that's the case, that's why, one of the reasons why inflation and GDP haven't been hit. Okay. The other reason that the Fed hasn't hit real GDP or inflation targets is because the velocity of money has collapsed to its lowest level ever. So theoretically, even if the Federal Reserve was pumping more money into the economy, the low velocity of money is mitigating or holding its ability back to increase, to hit its inflation and its GDP targets. And right now, the velocity of money has collapsed from around 9 times, where it turns over 9 times in the economy, to around 6. So there's been a pretty significant decline in the velocity of money. So if the velocity of money is falling and the money supply growth rate is falling, then there's no way the Fed is going to hit its inflation or its GDP target. And this eventually will be disinflationary and deflationary, which is not good for the economy. And as the GDP starts to slow significantly, again, that's not good for the economy either. Labor markets, the stock market, and obviously the potential for, you know, the last administration to control the Senate and the presidency. Okay, and that's how, this is how they're looking at it. Okay, and then the question is, if we fell into a recession, would the Fed use negative interest rate policy? The answer is yes. Why is that? Because interest rates are already at historical lows. And we've already gone to 0 before in the past. And, you know, the lower bound is, you know, if you go from, you know, 2% to 0, it's very different than going from 5% to 0 or 8% to 0 to stimulate the economy. Going from 2 to 0 is not much. So you would have to go from 2% to negative 2% to actually try to stimulate the economy. So the answer is yes. And then what would be the impact on the economy? In the short run, negative interest rates would stimulate the economy by lowering the cost of capital. So it would incentivize people to borrow and corporations to borrow, to consume and invest. What would it do to asset prices? It would cause asset prices to go up.
Like in the short?
Yeah.
Yeah.
Because we know from the perpetuity model, right, that this I here, this expected return, is the risk-free rate plus the beta times the return on the market minus the risk-free rate, which is your capital asset pricing model. So that's like the equation. So if we know that interest rates go negative, then this is going to cause the expected returns to go down, and it's going to cause the asset values of stocks, bonds, and real estate to go up. Okay, so that's how the mechanism would work. It would be good. It would help in the short run, but in the medium and long term, it would probably have negative feedback loops.
Sounds like all of this is good in the short.
Yeah, it helps stimulate it in the short run. I mean, you can continue, if you continue to stimulate the economy, it keeps going, but at some point in time, as we know, the Federal Reserve can't continue to print 30 to 40%, you know, of the money supply. So at some time they start to pull back, and that's when the markets convulse, and that's when the economy starts to slow. It would actually cause asset prices to go up in the short run. Savers would be negatively impacted because as they buy bonds at negative interest rates, they're actually lowering their standards of living. They're actually paying a tax to buy government bonds. They're paying more than the bonds are actually worth, which drives the yields negative. And then the principal that they receive at the end will be less. So they're actually getting less money. They're actually paying the government to buy their bonds, which is perverse. It's never been done before. For investors, it would be positive in the short run, but maybe not in the long run. And for businesses, it would also be positive in the short run because it'll lower their cost of capital. But eventually, the negative interest rates would limit the amount of spending consumers would get from their interest on the bonds, which would actually cause the overall economy to slow down in the future. So positive in the short run, probably negative in the medium to long term. So that answers that question. Okay, is everybody up to date so far? Do you want to take any pictures of that?
For businesses, I put they would pay back on dividends, is that correct?
No, the impact, negative interest rates effect for businesses would be lower cost of capital. Okay, so they'd be able to borrow cheaper and to invest. What they've actually done is they haven't invested over the last 10 years. They borrowed the money really cheap and then bought back their stock, okay, to inflate their stock prices. Okay, so it's an accounting gimmick more than anything. It's not, you know, the revenue growth and the earnings growth isn't driven by, you know, economic growth, you know, overall aggregate demand. It's driven more by a artificial accounting mechanism and a monetary illusion. Okay, that's why I call it unorthodox monetary policy, because it is unorthodox. Okay, is everybody clear on this one? Okay, so I'm going to erase all this stuff, unless you take a picture.
Just take one more. Got it.
Okay. So that's that. I know it's a lot to remember, but you just do the best you can. You try, and then you try again, and you try again. Usually by the third time you got it, right?
Yes, sir.
Mine's the, for this one, it's the, you know, the 3 attempt rule. Usually after the third attempt, you got it totally nailed down. I also adhere to the 5 rule. If I can tell somebody something 5 times, they usually get sick of me and say, you know, don't tell me again, I get it.
What's like in
That's
class?
the confirmation.
Answering a question, we'll keep asking it until it's
You
right.
know, just keep asking. And eventually you get there, right? So the yield curve, all right? So the Fisher equation, nominal interest rates, you know, IN. And these are gonna be interest rates on risk-free. Government bonds. US Treasury. US Treasury bonds. And Irving Fisher stated that nominal interest rates are made up of real rates plus inflation expectations. And real rates of interest don't move that much. I mean, they may move over on a secular basis or over the business cycle. So they really don't have an impact on short-term interest rates. So I hold that as constant. So really the movement in interest rates up and down are driven mainly by inflation expectations. So if inflation expectations go up, interest rates go down. Sorry, yeah, go up. And then when inflation expectations go down, interest rates go down. So when inflation expectations go up, interest rates go up. When inflation expectations go down, interest rates go down. Okay. And then if we use, you know, a perpetuity bond, or the perpetuity model, the C is the coupon payment based on the coupon interest rate, and you divide that by the interest rate. So here, if inflation expectations go up and interest rates go up, then the value of the bond goes down. And if inflation expectations go down and interest rates go down, then the value of the bond goes up. And that kind of answers that question, right? Using the Fisher equation, what variables drive risk-free rates? Nominal interest rates on U.S. Treasury securities by maturity up and down. It's inflation expectations. What shifts the yield curve up and down and flattens it and inverts it? Inflation expectations. So it's all driven by inflation expectations. And inflation expectations are determined by the bond market participants. They're people who actually hold bonds and invest in bonds. So let's talk about the yield curve. Now, the yield curve on the y-axis is going to be the interest rate, or the yield ITM. Okay. And then on the x-axis is going to be maturity of the bond. This is also called the life of the bond. And bonds are made up mainly of maturities of 3 months, 6 months, 9 months, 1 year. And then these bonds right here, 1 year and less. It's called the money market. So they're short-term securities. And then you're going to get into 3 years, 5 years, 7 years, 10 years, 20 years, 30 years, and then Steve Mnuchin wants to do a 50-year bond. Yield curves used to look like this, right, where the interest rate was higher. And then when we went to zero interest rates, we went here, and if we go negative, we're going to go down there. Okay. But I'm not asking that question. So this is how the yield curve looks. And then what I do is I put like this, put the dots, so that you can see that there's an interest rate that corresponds with each maturity. That basically makes up the yield curve. This is the detail that I like to see in these things. And then I go, I3, I6, I9, I1, I3, I5, I7, I10, I20, and I30. So that's basically what the yield curve looks like. And this is a normal. It's a normal curve or upward sloping. And you have to remember too, when the yield curve is upward sloping like this, the inflation expectations are positive. And we'll go through that in a minute. So the question asks, what would shift the yield curve up and down? Well, we know that the yield curve would shift up due to higher inflation expectations. Then the yield curve would shift down due to lower inflation expectations. And we also know that if the yield curve shifts up due to higher inflation expectations, that interest rates are going to go up and bond prices are going to go down. And we also know that if inflation expectations go down, interest rates will go down, and if interest rates go down, then the valuations will go up. Okay? So in this case, it shows that the yield curve is shifted up across all maturities for bonds, and that's due to higher inflation expectations. And here it also shows that the yield curve is shifted down across all the maturities for the bonds due to lower inflation expectations. And it's called across the curve. This would be lower inflation expectations across the curve. Higher expectations across the curve. Okay. All right. Then it also talks about flattening and inverting the curve. So let's say that that in the short term, the bond market, we'll talk about this a little later, is broken up into short-term interest rates, medium-term maturities, and long-term maturities. And as we know, and as we talked about earlier, is the Federal Reserve controls short-term interest rates, short-term maturities within the market. And they do that through open market operations. So the Federal Reserve, if they start to see the economy overheating, what they're gonna do is they're gonna start selling short-term bonds. And that's gonna cause short-term bond prices to go down and interest rates to go up, and that's gonna cause the yield curve to flatten. This is a flat curve. And if the Federal Reserve continues to sell those bonds and sells too many bonds, it's gonna cause the yield curve to invert. And we'll talk about the inverted curve in a second. So what I'm also asking you to do, on the exam, is to show me the 3 types of yield curves. Okay, 1, 2, and 3. Maturity or so this is what I'm going to be looking for. Okay, these are yield curves. Got it. We're going to do normal, flat, inverted. The normal curve looks like that. It's upward sloping in the Fisher equation. Is IN equals RR plus inflation expectations. And inflation expectations are positive. And then a flat curve looks like this. And IN equals the real rate plus inflation expectations. And these are going to be, inflation expectations are going to be 0 in a flat curve. And then an inverted curve, which is the way the curve looks now. We have short-term interest rates higher than long-term interest rates. Fisher equation, real rates plus the inflation expectations are negative. Okay, so that's what I'm looking for. And then there are 4 yield curve theories. The first one is the expectations hypothesis. Okay, and that's basically the Fisher equation. So the yield curve shifts up and back and moves. And remember that yield curve moves like this. Okay, shift up, shift down. You can move like this, but it doesn't move like this. It just flips around like that. Okay, and that's the expectations hypothesis, is the Fisher equation. Then there are 3 other theories that are related to each other. There's market, segmentation, preferred habitat, and liquidity preference. These are all related to each other. So market segmentation basically says that the bond market is segmented by maturity. Short-term maturities, medium-term maturities, and long-term maturities. So we consider the short end of the curve, the medium end of the curve, and the long end of the curve. Okay, when we talk about yield curves. Preferred habitat basically states that there are certain types of bond investors and people who borrow in the bond market, lenders and borrowers in the bond market, all are segmented by short, medium, and long term. Okay, and they prefer to be in those segments. Okay, corporations like to borrow and lend on the short term, and then pension funds, endowments, like to be on the long end, of the curve. that's where they prefer to be. And then liquidity preference basically states that certain bond investors prefer their liquidity at different times. So if I have some money and I want it to be working, I'm gonna, and I don't need the money for maybe 3, 6, 9 months, maybe a year, I'm gonna buy 3 months, 6 months, 9 months, maybe 1 year bonds. I don't need the money until that time period. And then some investors, want to get their money back in 3, 5, or 7 years. And then, pension funds, endowments, that are targeting actuarial projections of when their pensioners are gonna, start to claim their pensions. They're gonna need bond liquidity to come due during the time periods when they expect those liabilities to become due. So matching, their liquidity, when they're gonna need it, in the future. So those are the 4 areas. Any questions on those?
For the test, is it set up just like this?
Yeah.
Okay.
Yeah, it's exactly the same.
And then we'll have a blank blue book?
Yeah.
And we just,
Yep, I'll just give it to you and you go at it.
sweet.
Yep, and then you'll have money on Wednesday to take a stab at it.
Yeah.
And then I'll review, the whole package, I'll grade, what's gradable. And then I'll give it back to you, you don't have to resubmit those. And then the stuff that may need some more rework, you'll go back, maybe review the video or your notes,
Yeah.
make those corrections and then resubmit it.
Sweet.
Yeah. So it's pretty straightforward. I'm not a big exam type person, I like to just drive to the knowledge.
Yeah.
And everybody does well in the process. And it alleviates, if students adhere to my methodology, it alleviates a lot of stress.
Absolutely.
Although they're always just conditioned to stress around exams, right?
Yeah.
Because they think they're gonna get penalized.
For the inverted,
Yeah.
would it be good to know that the stock market S&P 500 peaks within 12 months
Yeah.
and then the recession?
Yeah, we'll get to that.
Okay.
You can answer that in that next question.
Okay.
Okay. And that one's really easy, right? It's pretty straightforward. And then it asks the theories, and then what impact do shifts in the yield curve have on asset prices? We already did that, right? So if the yield curve shifts up due to higher inflation expectations, then interest rates will go up and bond prices will go down. If the yield curve shifts down due to lower inflation expectations, interest rates will go down and valuations on bonds will go up. Okay. How does the Federal Reserve influence interest rates? The Federal Reserve buys and sells bonds in the open market. Okay. So the Federal Reserve is going to control directly short-term interest rates. Through open market operations, and they conduct that through the Federal Reserve Bank in New York City. And again, that's all they do is buy bonds, sell bonds in the open market to either drive bond prices up and down, interest rates up and down, to either stimulate or fuel the economy. That answers that next question. And then what is the objective of buying bonds? Bond prices go up, interest rates go down, stimulates the economy. Selling bonds, driving bond prices down, driving interest rates up to cool the economy. Okay. The Fed buys and sells bonds, what's the impact on bond prices? I already talked about that. What's the impact on yield and maturities? Already talked about that. Does the Fed control and influence directly short-term or long-term interest rates or both? The Federal Reserve directly influences short-term interest rates. And then indirectly medium-term and long-term bonds. Okay. So the perfect example is the inverted curve. Okay. So the Federal Reserve, to cool the economy, a little over a year ago, was starting to sell bonds, driving up interest rates. Okay. And then what happened? People said, well, the Federal Reserve raised interest rates too fast, too far, and we're going to be going into a recession. And that caused the medium and long-term interest rates to fall as inflation expectations fall. So it inverted the curve. And then everybody's complaining now that we're going into a recession and the Federal Reserve should buy up short-term bonds to drive up bond prices and drive down interest rates and get to a normal curve as soon as possible. Because we very rarely have, if ever, go into a recession when the yield curve is normal. It usually is when it's inverted. Okay, so everybody's screaming at the Fed. I need to do something quick. All right. So that answers that question too. Okay. And then the next one, did you guys want to take a picture of this and I'll erase it?
Yeah.
Yeah.
How long will this be going on?
Until we're finished, right? You want me to just blow through it? I'm not gonna do the problems on the back.
Yeah.
I'm just gonna do my section, because the other stuff's pretty straightforward. So how much time do we have?
Well, it's 12 to 2.
Yeah, I said till 1.
Yeah.
Yeah, is that cool?
Yeah, no, that's fine.
Okay. What?
My friend wanted to know how long this was going.
Oh, okay. Yeah, we'll try to get out of here by 1. Maybe like 1:10 or something. We can get through it pretty quickly. I'll try to get through it as fast as possible.
I just wanna know what time so that she can get here.
I told her to come over here now and like eat some apples and cookies and load up on chocolate and stuff. More the merrier, right?
Exactly.
Alright. And these videos are really training videos, the way I design them. Okay, so let's do the next one. What are the overall observations of the relationship between the yield curve and the S&P 500? The S&P 500 has been done like this, right? Crazy, right? Over the last, since 2000. There's your resistance, there's your support line. And what we found out is that the yield curves in this phase, are normal. And then what happens is they start to flatten, and then they invert right before the curve, right before the peak. So almost every time, if you go back years, you start to see normal and then inverted curves. And actually, right now, the curve, it's been basically upward sloping and really low until recently, and then it started to flatten, and now the curve's inverted. And through that observation, and that was from the dynamic yield curve. That was from the dynamic yield curve from stockcharts.com. This is more detailed than you probably want to do, but you throw it in there, that's cool. But what we found out is that right before the peak in the stock market is that the curve inverted at 12 months. Once the curve inverted, the S&P 500 peaked in less than 12 months. And that once the curve inverted, we were in a recession in less than 24 months. And I think after yesterday's announcement, the probability of going into recession is even higher. Not only because of the inverted curve, but because of the global trade wars. And now the Trump administration is shutting off capital flows into China, which basically means that China will be starved for capital and the economy will probably go into a recession.
Theirs or
And
ours?
bring the rest. Theirs, and then we'll probably follow. Because if the global economy goes into a recession, we're going to go too. Okay, you just can't get around it. All right, so that answers that one. And the next one's capital and commodity markets. I was looking for that table. We have asset classes. And then you're going to have the level. And then you got the trend. Up, down, say the percent change or dollar change, in the level. So I was looking to see if you could do the market analysis, look at the charts and identify the levels and then the trends, and then calculate some percentage changes.
Do you want us to memorize, like the bonds,
Yeah,
like the
Yeah.
day before we go in, just
no, you can just give me a relative
a
value.
relative?
Yeah, the level.
Cause they're all pretty, like you want like the past month,
Yeah, you can just give me whatever.
whatever.
Yeah, I'm just testing to see if you're even looking at the market.
Okay, for sure.
So, this is oil, gold, bonds, and then this is what, US dollar, against foreign currency. And then the Dow Jones Industrial Average is what? Where is it today? Around, what, 27,000, something like that?
26 mid.
Something like that. 26,500, you know, I'm just trying to see if
Yeah.
you're even close, right? And then is it up or down? Basically, other than yesterday, but overall it's,
It says it's down by 26%.
yeah, that's in one day, but the question is, what's the trend been, you know, over the last month or two? Yeah, it's been up, right? And the question is how much, you know, it's probably been up maybe, you know, 2 to 5%, something like that, I'm just guessing. And then the question is, you know, why has the stock market been going up? Well, you know, the lower, you know, interest rates. And then actually there was some pretty good, you know, economic data that came out, so the economy was stronger than everybody thought it was. So I'm just, you know, looking at high level. And then where's oil? It was what, like 60 something dollars a barrel? Something like that? 63 or something? I mean, it never got to 70. I think it's hovering around maybe 57 or $63 a barrel, something like that. And the question is, you know, is it up or down? It went up after the explosions, right? And it seems like it's been trending up too. I mean, gas prices are at their all-time high right now, you know, compared to almost 2007, 8. So oil prices have been going up. Recently they've been coming down, but it looks like the trend has been going up. And how fast have they been going up, let's say over the last, is that what you guys are getting?
I'm trying to-
You still trying to find it? Yeah, let's just say they've gone up like, you know, 5 to 10%. Or you guys, correct me if I'm wrong, and I'll just make the adjustments if you find it. And then what would be causing, you know, oil prices to go up? You know, cutbacks. Cutback in production, you know, by OPEC. You know, terrorism or bombing or, you know, supply. Supply chain disruptions, supply line disruptions. And we know that the economy is continuing to grow. So, you know, moderate global economic growth. Most of the world hasn't gotten into a recession yet. So I would just, you know, say, you know, positive GDP. So those would be, you know, the factors. Okay, and then where's gold trading right now? I thought it was like, I thought it was, what, like 1,600?
Right now it's 1,500.
Yeah, so around 1,500–1,600. And gold prices have been going up. Right, and let's say, you know, 5 to 10% over the last year or two. And then what's caused gold prices to go up? Basically geopolitical risk. Political uncertainty, wars, Middle East instability, you know, drives people, you know, into gold. Where's the 10-year treasury yielding right now? I thought it was like 1.67 or something like that percent. it hit its all-time low, like about 2-3 weeks ago, and then it's come back up. So it's been trending up. What did you have?
Oh, I just had 1.7 for bonds.
Yeah, so it's
Same thing. And it's going up.
So it's been trending up, right? And then it's probably been going up, I don't know, like 25 basis points. And what would cause,
Higher.
bond prices to go down and interest rates to go up?
Slow economic growth.
I would say positive
Devaluation.
economic growth. Yeah, there has been devaluation,
Higher inflation.
in currencies. Not necessarily inflation. I don't think that was really the factor, but, positive economic growth has increased inflation expectations. So, yeah, that would do it. And then, since people are seeing that the stock prices are going up, they're selling off the bonds and going into the stock market. So, stock market returns. Okay, so those are just some factors. And then the US dollar to the pound, so the dollar pound, I believe, is what, 1.21?
1.24.
1.24, and then the dollar to the euro was like 1.11 or something like that, I think. Right, and I think that correct me if I'm wrong, that the dollar, I know the dollar to the pound has been going up. Let's just say that the dollar to the euro has been going up too. Okay. And let's say it's gone up, I don't know, 2% or something. And what would cause the dollar to the pound, dollar to the euro to go up? Devaluation in the dollar, right? Devaluation. The dollar depreciates, right? And it costs me more to buy foreign currency because we're depreciating and foreign currencies are appreciating. So that's kind of what I would put down is depreciation, devaluation in the US dollar, and then appreciation, revaluation in foreign currency. That's what I'm looking for, something like that. Okay? Got it?
Yep.
Got it. I'm not gonna go through the whole dynamic supply-demand analysis. I think you guys got that right. So basically, when the supply curve shifts back, prices go up. When it shifts out, prices go down. And when the demand curve goes up, prices go up. And when the demand curve goes down, prices go down. And then there's the different factors, right? Stocks, right? Shifting back is going to be buybacks and reverse stock splits. Shifting out IPOs and secondary offerings. Demand curve goes up due to higher expected returns. Demand curve goes down due to less people don't want as much risk and they want to go into bonds or gold because they're scared of a recession or political. For oil, shifting back is going to be OPEC cuts. Shifting out is going to be OPEC production, fracking. Demand for oil going up is going to be mostly economic demand, population, those things, and then demand for oil going down is going to be mostly economic factors. And then for gold, shifting back is really hoarding by central banks. Shifting out is going to be selling by foreigners and central banks. Demand curve for gold going up, geopolitical risk and higher inflation expectations. Demand going down is going to be lower geopolitical risk and lower inflation expectations. And then for the bonds, the supply curve shifting back for bonds, you're going to be running budget surpluses and you're going to be buying and basically maturing those bonds or canceling out those bonds. And as the bonds start to mature, the supply curve will, and you don't replace them, the supply curve will shift back. Running budget deficits and having to issue more bonds to cover the budget deficits would shift the supply curve out. Demand for bonds would go up, prices would go up, and interest rates would go down. when people think that there's gonna be lower inflation and lower interest rates, or they want to, liquidity and they want safety, they'll go into bonds. That'll cause the demand curve to go up. The demand curve to go down for bonds is gonna be higher inflation, higher interest rates, and people not needing the liquidity and the safety, and they go back into the real estate market, or they take the money and they go back into the stock market, because they think they can get higher returns in those markets than on the bonds. And then the last one is the currencies, okay, the values. So what would cause the supply curve to shift back? For the dollar, basically the Federal Reserve selling bonds in the marketplace. Because as they sell the bonds, they're pulling cash out of the marketplace. And then what would shift the supply curve out for dollars? It's going to be printing, of money by the Fed, and then also the Fed's buying bonds and injecting dollars into the economy. What would increase demand for the dollar would be higher productivity, higher employment, higher GDP, devaluation of foreign currencies, safety, liquidity. Those are all factors. And then what would cause the demand curve to shift down for the US dollar, causing the value to either depreciate or devalue. Remember, devaluation is due to government intervention or government institutional intervention. Depreciation is due to the market. So depreciation, appreciation is market-driven factors. Devaluation, revaluation is institutional market intervention. And then the last is the demand curve shifting down for US dollars. That's going to be lower labor productivity, higher expected returns, revaluation of foreign currencies and markets, higher inflation rates, lower interest rates, lower expected returns on the stock and the real estate market, would all cause demand for the dollar to go down. So that's just kind of a summary, okay? And then financial innovation engineering. I'm just gonna read through this. I'm not gonna go write the whole thing out because it just takes too long to go through all that stuff. But the first is the prerequisites for financial product and process innovation. One is that the company constantly scans the environment, looking for opportunities, and changes in the environment or changes in the market could come from changing regulation or increased competition. These companies understand industrial psychology, they understand the dissonance between individuals and where their objectives are, and they understand not only individual psychologies of individuals for motivational purposes, but also group psychology and groupthink. They're willing to conduct restructuring of the organization and the company, so organizational change and the culture of change management. They understand cultural leadership by management, and knowing that individuals in the company will model the leaderships and go through the process of self-efficacy to basically act out and behave like the leaders. There needs to be clear strategy, tactics, and operational metrics, goals and objectives. So you need clear planning, and it needs to be communicated and understood at all levels of the organization. That basically sets the environment for a culture of product and process innovation. Companies need to have an enterprise resource planning system, or an ERP, in place that basically records all of the products and services that have been developed in the past. I was talking about my wife doing all that project management. All of that stuff was tracked and recorded and put into a knowledge base that would allow them to refer back to it at some point in time in the future. In the process of product and process innovation, the company recognizes the needs and wants from the marketplace and starts to develop the product. They have an ongoing research and development arm that basically will build these products and processes with the attributes, the product attributes, to solve the market problems. Once they've tested it, then they can move into production and manufacturing and distribution of these products. If they don't have an existing distribution channel, or networks, they will buy it or they will build it. So they have to be able to understand their channel distribution, the networks, and then optimize the channel distribution mix. They do the exact same thing with the supplier networks and the supply chain distributions. They optimize that also. Then they can move into the business development, marketing, and sales phase, where your marketing research department will identify the market segments, either by psychographic, demographics, industry, company size, and those will be the target markets that they will target for advertising campaigns to generate the fees and commissions and get the assets under management. They will also use the advertising along with other methods for prospecting clients with the goal of converting the clients as clients and lock them in to generate perpetual revenue streams by selling them or cross-selling them or upselling them new products or bigger products. The goal is to increase the velocity in the sales cycle and also the scale of the sales. Okay, moving from smaller transactions to larger transactions faster is really the goal for revenue growth. And then your customer service is the next thing, where the focus is on retention of the clients, but also customer feedback, where the customer basically gives you suggestions on new products with new attributes that will solve their problems. The next is to look at these markets. One is to look at the S-curves. If the company can consecutively and consistently develop new technologies consistently over time, the market will recognize that and give them a upward sloping revenue growth path. If you use the Gordon growth model, which is future cash flows divided by the expected return minus the constant growth rate, the constant growth rate will be maximized and the enterprise value will be maximized if the market recognizes that the company can be continuously successful in developing these technologies. The same thing is with the product adoption cycle, using the marketing literature. The product adoption cycle is broken up into multiple phases. The first is the innovator stage, and then eventually using social media and other techniques, you move into the early majority adoption phase, which is also called the hockey stick, which is where your revenues and your costs are growing exponentially. But then, as almost everybody in the market has adopted the product, you move into the majority phase, and then the revenues will start to decline, and you move into the late majority and then the laggard stage. So the key there is to be able to develop continuous series of new products over time to create the upward sloping revenue growth path, to maximize the growth rate in the Gordon growth model, to maximize the enterprise value in the firm. When you enter into these product development, you have to conduct feasibility analysis, and you basically figure out what the cost will be to develop it and market the product. You have to compare that against the future cash flows generated from the process and the product, and discount those cash flows back to the present. You take the present value, you subtract out your sunk costs or your costs to develop the product, and if your net present value is positive, you do it, and if the net present value is negative, you don't. You also use break-even analysis and internal rate of return analyses, which is also financial feasibility analysis is also called capital budgeting, which we'll learn about in the second third of the class. And then the last prerequisite for successful product and process innovation by these companies is to use a rules-based approach to know when to enter the market and when to exit the market, and to create a capital event. The question is can we enter the market decisively and execute and bring a successful product to market and generate the revenue and the value to the firm, or do we decide to keep those product division, or that product division, internal to the firm because it adds more to the enterprise value, or is that division of products worth more as a standalone public company, and we basically take the company public, receive the cash from the initial public offering and take that cash to develop new divisions and new products and new services and do it all over again. And that's basically how we do it. Okay?
Is that one of those things that's on the video?
I just, yeah, I wrote it out on the board,
Okay.
and then I just read it.
No.
Okay, so it is, and I sent those videos to you yesterday.
Yeah.
And the different classes, the different sections are different. It seems like my second sections are better than my first sections.
For what?
For the lectures, to go over the exams.
Yeah.
And this one will be a good one too. Because it's closer, right?
Yeah.
And how am I doing on time?
Great.
How much time do I have?
It's about a half an hour till 1.
Okay, good.
As much as you need.
Well, I gotta be back too.
No traffic though. That's good.
Yeah, I should be able to get over 1 hour. And then we'll do we're gonna do the modern and postmodern portfolio theory. Okay, next. This is how I would draw it out. So I would start here and do the capital allocation line, and then you put the risk-free rate. This is gonna be the portfolio standard deviation there. This is gonna be the expected return on the portfolio. Okay, are you guys all ready? Yep. And then I would go here, go right to the middle and put the market basket there. And then what I would do is I would put in the first utility curve, like that from here. That way you make sure that if you do it like this, you're gonna make sure that the utility curves and the efficient frontiers are tangent to the capital allocation line. Okay. A lot of students just will put that in and they'll draw in the utility curve up here like that. It won't be tangent. And then they'll draw the efficient frontier down here like that. So they didn't get it. Okay. They just slapped it in there. So I would put in my utility curves. Right here, U1, U2, U3. And remember that, the investors want to be up here, right? High returns and low risk, but there's nothing, I can't build a portfolio like that for them. So what they have to do is they have to lower their utility to the point where the utility curve is tangent to the capital allocation line. And also, and this is how I would do the efficient frontier, is do it like right there, like that. And then this one has to come down, it has to be above this risk-free rate, right here, so like that. So that's how I would do it. And then from here, you go like that, boom. And there's your efficient frontier umbrella. Did you have a question?
No, I just messed up.
Okay, I know. I know, isn't it brutal? Yeah, it's brutal. That's why I have whiteout. You want to borrow some of my whiteout or something?
No, it's okay.
Okay.
I'll just mark it.
Yeah. I use whiteout, and I just white it out. And then here, you want to make sure you put the dots, along the efficient frontier. Right here, all the way down. Put some dots right there. These are all portfolios that we can construct. Portfolios we can construct are along the efficient frontier, and then inside the efficient frontier are all the assets that we can construct to build these portfolios. Okay. Then here, this dot, and I would put these like this, the standard deviation for stocks for the portfolio. So this is going to be 100% stock portfolio. Okay. And this is my expected return on stocks, my stock portfolio. So it's going to give me a higher risk, but I'm going to be compensated with higher return. In this portfolio that we're constructing is just a 2-asset portfolio. It's just stocks and bonds. Okay. And then down here you got 100% bonds. Return, bonds, and then you got the portfolio standard deviation for bonds. Okay. The market basket right here, and I'll go through what the market basket but it's basically the universe of investable assets by percentage. It's just a pie chart. And here, this is gonna be you're gonna get the highest expected return here at the market basket at the given level risk. So it's like the efficient point. And at that point, you got your expected return on the portfolio divided by the standard deviation. The portfolio equals the risk adjusted rate of return, or the risk adjusted rate of return. Got it. And these are all starred. Okay. Got it. Then you can jump off the efficient frontier and move up the capital allocation line to a point that's going to give you significantly higher returns, but also you're taking on significantly more risk. And the way that you do that is by using leverage. So for your stocks, you're using margin, and for your real estate, you're using mortgage finance. And remember that when you apply leverage to your portfolio, your return on equity is going to increase significantly if prices go up. And the return on equity is going to go down significantly when the prices fall. Okay. You can also jump off the efficient frontier and move down the capital allocation line through the process of lending. And that's what banks do. Okay. And the banks, what they'll do, actually I'll do it right here. It's a better place to end. The banks are more concerned about lowering the portfolio risk than in receiving lower return. They're really focused on. So they're willing to take lower return for significantly lower risk. So this is going to be the expected return from lending. Okay, so that's kind of cool. They can do that, and that's what they do. And the reason why it's the risk is reduced is because the brokerage firm and the bank basically will lend on your securities and lend on your real estate. But if you default on your mortgage, they're going to foreclose on the property and they're going to take it. So your loan is actually collateralized, by the home. And then for the brokerage account, let's say the prices go down on your stocks, the brokerage firm will issue you a margin call, and if you don't put up the equity, they'll sell off the stocks and they will liquidate your stock portfolio to pay off your loan. Okay. All right. How are we doing so far?
Just a lot of information.
Yeah, it's a lot of information. Basically, what we go through in this class is kind of a mini masters in finance. So for people who don't major in finance, that then go on, they have all the knowledge pretty much they need. And if they want to go and get a master's in finance, they'll have a lot of that. So it kind of gives you all the tools that you need to have conversations with people. Can I erase this here?
Yeah, can I get a picture of it real quick?
Yeah.
For the exam, would you say like, would it be okay if we use different colors then?
Yeah, you can use anything you want.
Okay.
Yeah. I mean, I'm looking for detail.
Yeah,
So.
it just makes it easier, I think,
To do
break
in
it
color.
up, yeah.
I was that's what I did when I was doing my econ degree, is I was doing everything in like multi-colors, because it just, my brain thinks three-dimensionally and thinks in color, not black and white. And I actually learned better that way too.
Me too. On this one,
Yeah,
the red one, doesn't the line go all the way across or no?
which
On
one?
the other side.
Oh, yes, it does, thank you. So I forgot to put the expected return, using leverage. Okay, excellent, thank you for doing that. Anything else, do you guys see any other mistakes on this? Okay, did you get this?
Yeah.
So I can erase that now. So what I want to do now is talk about the market basket, because the market basket has changed over the last 80 years. And the introduction of alternative assets has significantly changed the way we as portfolio managers manage our portfolios. So this M right here is the market basket. And this is basically a representation of what the market was like decades ago. And us as portfolio managers were very limited to what we could use to construct these diversified portfolios for our clients. So I would say, 1945, post-World War II to 1970, the market was made up of 70% bonds and 30% stocks. That was pretty much what we had. And then from 1970 through to the 1980s, a new asset class emerged based off of the portfolio analytics by a company called Ibbotson and Associates. And Ibbotson basically ran it and said, okay, you need to add at least 10% of your portfolio to direct equity real estate. Because we found out that the returns on real estate had low, no, and negative correlation to stock and bond returns. Okay. So it became pretty compelling. So we left the 30% to stocks, and we took 10 percentage points from the bond allocation. And then in the 1990s to roughly 2000, Ibbotson did the research again and said we should be allocating at least 10% of our portfolio to cash value, life insurance, particularly from mutual private insurance companies. And we kept the allocation to real estate at 10%. We kept the stock allocation at 30%, and we reduced the allocation to bonds to 50%, because all of these acts like an inflation hedged bond or proxy to a bond. And then from 2000 to 2019, a company called Deutsche Bank, Brief, conducted the analytics again and said that you should have 10% of your portfolio allocation to alternative renewable energy. And that would be wind, geothermal, biogas, solar, and now with policies in California, and it seems like the global pressure to mitigate global warming, that the push towards developing these renewable assets will only increase over the next 30 to 40 years. Okay. So we kept the allocation to 10% to life insurance. We kept the 10% real estate, kept the 30% stock, and we lowered the allocation from bonds to 40%. And bond prices have actually become more volatile over the last 10, 20 years, so reducing the allocation makes sense. So these assets right here are called alternative assets. And these have become extremely popular over the last 10 years. And the reason why people like these alternative assets is because their returns have no low or negative correlations. And with stocks and bonds. So it becomes pretty compelling that you need to include these alternative assets within your stock bond portfolio for diversification purposes. And what happens is because these asset classes, these alternative asset classes, when they have low, no, and negative correlations with stocks and bond returns, and you add them to your stock bond portfolio, what happens is it actually blows out the efficient frontier. And that's a key component to this theory. Okay. This is an applied theory. I modified the original theory to take the reality into consideration. So it bows out the efficient frontier. Okay. By bowing out the efficient frontier, you're going to lower the expected return on the portfolio, because these alternative assets don't return as high as stocks. So you're going to lower the expected return on the portfolio. But the portfolio risk, the portfolio standard deviation, is reduced significantly more, which actually causes the risk-adjusted rate of return to go up. And if you can give your clients, you can put these portfolios together and get your clients an expected return. Expected return equal to 8% to 10%. If you can lock that in for them, then obviously the rule of 72 states that you would be able to double their portfolio value in less than 10 years, or 7.2 years, if you can get them a 10% rate of return. And that's exactly what the clients want. And that's exactly the goal that the portfolio manager is trying to achieve. Yes.
Can you explain that line you just did? I don't.
This one right here, the bowing out,
Yeah.
the efficient frontier.
Uh-huh.
Yeah, because these asset classes
Yeah.
have low correlation with the returns on stocks and bonds. So what it does is it pushes the risk down.
Oh.
And if they have no correlation or low negative correlation, they're moving in the opposite direction. So it pushes the portfolio standard deviation of the risk in the portfolio down significantly. And then if you can lock in the return and push this risk down, this risk-adjusted rate of return goes up. And if you can get them this 8 to 10% rate of return and do this through diversification using these asset classes, then the money will come in and your portfolio will explode. They'll be just giving you money. And your assets under management will turn into that. Like a lot of these companies, portfolios they're like 50, 100 billion. BlackRock in San Francisco, their portfolio is like 3 trillion. Because they've been able to do this.
Yeah. Okay.
So, okay. And then the last piece is the estate planning piece. You know, the high net worth individual, but actually it can be applied to people like yourselves too, where the life insurance exposure to hedge off your mortality risk, because you're all assets, right? Your assets, you have intellectual equity in yourselves, you have human equity, human capital, you have intellectual property embedded in yourself. And as you move through your life, you're gonna be influencing and you're gonna be taking care of a lot of people around you. Either nonprofits, for-profits, companies, families, you know, so your responsibility gets larger. And as your responsibility gets larger, if something was to happen to you, it would be devastating for all of those people and those institutions around you. So what you would need to do is to get life insurance, okay, to hedge off the damage that would be done if something was to happen to you. And I believe that life insurance is one of the most brilliant products ever designed, you know, 167 years ago, and you can even go back hundreds of years when they were designing it in Europe. So what happens is when the person passes away, the life insurance death benefit kicks in. It goes into the estate, goes into the portfolio, and the portfolio return increases significantly, and the beneficiaries associated with the estate actually move up onto a higher utility curve, which is where we wanted to be originally. So through the use of life insurance, you could actually get the people around you onto a higher utility curve, which is where everybody wanted to be from the very beginning of this lecture, okay, in this process. So that's that, okay? That's kind of what I'm looking for. Most people do really well on these exams. I would say at least 70 to 80% of the people do really well, because they try hard. And then the other people just didn't study or something happened, and then I just make them go back and do it again.
Sorry for all the
That's
questions.
okay, no, I appreciate it.
On the one we did in class, we had the negative RF.
Oh, I took it down as just an example.
Oh, okay, so do we actually need that then?
Is it on there?
I mean, the one that,
I do ask.
yeah, we did in class, it had it, but it didn't, it just said,
Yeah, that one,
it's a 10.
that one's, you know, you could put it in.
Okay.
It basically just states that, you know, we were talking about negative interest rates,
Yeah,
right? So if the risk-free rate goes negative, right, your risk-free rate is gonna turn negative, and what it does is it just takes this whole thing and basically shifts it down,
okay,
right, is what it does. Which basically means that your expected return on the portfolio is gonna drop significantly.
got it.
So
Okay.
you're gonna be worse off,
Okay.
right? Because the return on your portfolio, your returns are gonna be really a lot lower than they were
Yeah.
before, when interest rates were higher.
Got it.
So that kind of ties the unorthodox monetary policy lecture right into the portfolio analysis.
Okay.
And I didn't want to have to rewrite everything.
Okay,
So,
no,
but
I was
if
just
you-
making sure.
But if you understand that, I mean, that's awesome.
Okay.
Okay. All right. Any other questions? You want to take a picture of that?
Already did.
And how am I doing on time? I'm almost done.
10 minutes.
Yeah, perfect. We'll finish it because it's pretty easy. Okay, I'm gonna erase this. Is that okay? And remember, you got, you know, two days, you know, to work on it. You got pretty much all week to study, and if you wanna come see me, you know, in the morning and stuff like that, and go over anything else from the time if you go over it, you know, more intimately and, you know, in more detail. So let's do the next one, which is the derivative trades. Okay. And these are pretty binary, you just gotta memorize it. So you got the index, you got the ETF, ETFs, and you got the stocks. Okay. The first is what do you do with, you know, prices that go up. Okay. There's 4 trades there, and then what do you do when prices go down? And there's 4 trades. trades and the stock trades are exactly the same. So if you get one, you know what the other one is. And if you think prices are gonna go up, you're gonna buy forwards. You're gonna buy futures. You're gonna buy calls on futures. You're gonna write puts on futures. For the ETFs, you're gonna buy on margin. You're gonna buy calls. You're gonna write puts. We do the same for the stocks. You're gonna buy calls. You're gonna write puts. And that's it. Okay, for that scenario, for that trade. And then if you think indexes are gonna go down, you're gonna write forwards. You're gonna write futures. You're gonna write calls on futures. And you're gonna buy puts on futures. Got it? You're going to, for the ETFs and the stocks, you're gonna sell short. You're going to write calls. You're going to buy puts. It's the same. If it's not shorts, it's short. It's not Tommy Bahama. It's all right. And you might want to put a little note down here, because when I did the portfolio, that whole portfolio thing, you can actually bow out the, I didn't have this on the exam, but just so that you know, it'd be like extra credit. You can also bow out the efficient frontier, and lower the return and lower the portfolio standard deviation by applying these derivative trades right here as portfolio insurance. So if I think the returns or the prices on the securities or the assets in my portfolio are going to go down, I'm going to execute these trades. Okay, and that bows out the efficient frontier. Okay. That's kind of just a bonus thing. And then the technical analysis looks like this. I would set up the chart. Okay. And then the chart should have 2 on the bottom and then 1 like this on the top. Okay. And this is going to be RSI. I don't care if it's RSI or MACD, I don't care. These are just basically technical indicators for momentum for the stock. Okay. And this is the volume chart. The volume of the trades, number of trades for the individual stock. And we're doing Yahoo here. So what'll happen is that we usually go back 3 years and look at the stock behavior, the stock patterns. Usually it's pretty squiggly. It'll go up, it'll go down like this, and then it's going to break up. This, maybe go like this, like that, like this. This, boom, something like that. Kind of normal pattern. For a stock. Right here, you can see that what the stock was doing was forming a bottom, okay? And this is called the support line. As you can see that the stock was forming a top here. And this is called the resistance line. And then some information came into the market that caused the stock to break out to the upside. And then you can see that the stock went up and down, and it looks like it formed another support here. Looks like it formed another resistance right here. And this is called, these are called shoulders. One shoulder. This is called the head or the peak. And this is called the head and shoulders pattern. Okay, head and shoulders pattern is what this is right here. Then it looks like it bottomed on the support, then it looks like it broke out to the downside. Or we could just say break, B-R-E-A-K, downside. Got it. And then it looks like it started to form another bottom right here. It's in a, these are, when these patterns right here are called sideways patterns. They're also called accumulation phase. They're also called a consolidation phase. Since the stock is trading sideways, it's called sideways pattern or trading sideways. And stocks will trade sideways, or they'll move sideways like this when there's not a lot of information. That's moving the stock price. So then and then you can see here is another breakout to the downside, and it looks like the support here. The support here was formed back where the prices were at its resistance. Okay, so you see a lot of that. And then it broke to the downside. It looks like it was forming another support here, back to its historical support for. And then it broke out to the downside again. As you can see that the stock was in an upward trend. Then it went into a downward trend. And then collapsed eventually. And that happens to startup companies and tech companies and stuff like that. Some will continue to go up over time, but some flame out because of technology, or the CFO did something stupid, or the market changed, or they didn't do anything, or something happened. What you'll find is that when the stock prices go up, the volume, the buy volume in the stocks will go up with it. And then when they start to trade sideways, the volume will start to flatten out. There's not a lot of interest. And then when it goes into a strong upward trend, the volume spikes, maybe comes down, then spikes again, as you reach its peak in the shoulder. And then as you can see, it consolidates, and then it spikes again as everybody's selling it. And then it spikes again as somebody sells it. And then it just keeps, everybody's just dumping the stock. So the trading volume is another indicator. Okay? And then the MACD kind of, when the stock prices go up, the MACD goes up, and then when it goes like this, it starts to slow, and then it goes up with the stock price and goes down. So it moves up and down, with the stock price. But if the MACD along with the RSI are in a downward trend, and that means the stock price is going to continue to go down. So you can use those to forecast what stock prices are going to do. And there's some theories, around the technical analysis. One is Dow theory. This is mainly momentum trading. I can also build models, regression, or moving average. So I bring this up because the book doesn't talk about it, and the investments book doesn't do even this good a job, in my view, explaining technical analysis. You're learning fundamental securities analysis, but you need to understand technical analysis, because most traders who are trading stocks and currency and bonds and stuff use more technical analysis than they do fundamental analysis. Although nobody really teaches it here because most of the finance professors are PhD finance, and they're looking more towards theoretical models as opposed to building quant-based application models around trading technicals. So it's a different, like industry academia kind of differentiation. And then the last question, how much time do I have in my own time?
It's 102.
What?
It's 102.
102, oh, so I'll be done in a few minutes. I'm gonna do this.
That was the technical.
That was the technical.
Okay.
And that's kind of what I was looking for. If you can replicate this pattern and put this stuff in there, that would be freaking awesome. That would be awesome. Okay, and then the last is the fundamental securities analysis, fundamental valuation theory. And there's 4 intrinsic valuation methods. First is the perpetuity. And the perpetuity assumes that the cash flows, and again, the cash flows can be earnings, could be earnings per share, earnings at the enterprise level, the company level to value the company, earnings per share to value the stock, it could be EBITDA, earnings before interest, taxes, depreciation, and could also be EBIT per share. So these are going to be your stock cash flows. These are going to be the enterprise value cash flows. Okay? And it's T plus 1. So we're always looking at cash flows a year out in advance, and maybe more. So you take that and you're going to divide that by your expected return. This is also called the discount rate. And what you'll learn, and you've already learned, is your expected return could be calculated using the capital asset pricing model, which is the risk-free rate plus the beta times the return on the market times the risk-free rate. And we'll get into that a little bit more, but that's just kind of a footnote. To get the value using the perpetuity model. So we know if cash flows are projected to go up, the value is going to go up. The cash flows in the future are projected to go down, then the value is going to go down. If the expected returns due to lower interest rates go down, then the valuations are going to go up. And if the expected returns go up due to risk-free rates going up or market risk going up, then the value of the share of the company is going to go down. Okay, that's kind of the theory behind that. You've all done a bunch of these things on your homeworks and fixed credit problem set and all that stuff. The second model is the Gordon growth model. It's also called the constant growth, but I like to call it the Gordon growth. You might as well give them credit, right? I mean, you won the Nobel Prize for it, so you might as well give it to them. This one assumes that you're going to take the same future cash flow projection divided by your expected return minus the constant growth rate is going to give you the value of the company or the value of the share using the Gordon growth model. So if we hold the expected return constant, if the growth rate expectations and future cash flows go up, then the value of the firm is going to go up. If the future cash flow expectations or growth rates are going to go down, then the value goes down. Then the next method is the multiple approach. And that basically, you take the same cash flow, T plus 1, times the multiple, the future multiple, T plus 1, is going to give you the valuation, T plus 1, using the multiple approach. And actually, all of these methods will give you the valuation in T plus 1. These are all forward-looking valuation models. So what is the multiple? The multiple could be, I go out and I find, company sales. The company was sold. So I go out and find the dollar amount in which the company was sold for. And then I can divide it either by the earnings, they're established companies, or I can divide it by the EBITDA, or the free cash flow. And that's going to give me a multiple. So is it 10 times future cash flow is the value? Is it 20 times future cash flows is the value of the company? I can do the analysis and find the recent sales to be able to get the value of the company. I can also manufacture multiples. If I'm doing share prices, I can take the stock price and I can divide it by the earnings per share, or the EBITDA per share, to get the price earnings multiple. If I'm using price to earnings per share, it's called the PE multiple. That's what it's called. Okay. So those are two ways I can get market-based multiples. If I know what the market did, and I projected my own cash flows, I can figure out the value of my company or the value of my stock. I can also manufacture a multiple using the perpetuity model. 1 divided by I, it's going to give me a multiple. And I can also use, if I assume that the cash flow is going to grow at a constant rate forever, I can use the Gordon growth to also create a multiple. If I use these two methods, 1 divided by I times the cash flow to get the value, it's going to be exactly the same as the perpetuity result. And if I use 1 divided by I minus G to get the multiple, times the future cash flow, I'll get the same value as the Gordon growth and the constant growth model. Okay? And then the last model is the discounted cash flow. Or the DCF. What it's called. What we're trying to calculate here is the present value, or the PV, company. The assumption is that you're going to sum up all of the future discounted cash flows. I'll give you a quick example after this. Plus the terminal value, discounted back to the present. So if I want to calculate the present value for a 2-year, buying a company or a piece of real estate or whatever it is. I'm going to forecast, I'm going to take the current cash flow, t equals 0, multiply it by some growth rate to get the next year's cash flow, and I'm going to divide that by 1 plus I to the 1. So let's see, my expected return is 20%, it's going to be 1.2. 1. And then I'm going to take the second year's cash flow, plus 2, divided by 1 plus I to the 2. Let's say 20%, this is going to be what, 1.4 something, right? As an example. And then what you're going to do is you're going to grow this out. Okay, one more year. This is the end of the holding period right there. So you're going to grow this out one more year. 1 plus G, and you're going to get CFO T plus 3. Okay. Then you take that CFO T plus 3, you divide it by I minus G, because you're going to assume that these cash flows are going to grow forever. And this is going to give you the terminal value. Then you take the terminal value and you add it to that. And then you discount it back to the present to get the present value. That's a little bit more of an extended definition. We'll be doing more of this. We've already done all of this stuff. And I'll go over this, a bunch of times. But, if you just give me that, that's awesome. If you give me this, that's even better. It's just a little bit more. Okay. All right, that's all I got. Okay. So what I'll do is I'll probably upload the video and I'll send that out to everybody. It has just another training video for you guys. Okay.